We are going on with the next topic of the lecture of the first module, Introduction to Digital Finances and Financial Innovation, which is evolution of digital banking. And today, let us embark on a journey through the transformation of banking on the digital age, from those first groundbreaking innovations to the cutting-edge technologies which are reshaping finance as we speak. And what strikes me most about this story is the incredible pace of change we are witnessing. And for example, when I started my career in this field, mobile banking was just emerging. You can imagine. And now we are looking at the AI-powered assistants, quantum computing on the horizon, and on banking services embedded invisibly into our daily lives. And throughout this lecture, you will gain insights into the key milestones that have defined this evolution, and also disruptive forces challenging traditional models and the technological breakthroughs driving innovation forward as well. And my goal isn't just to show you where we've been, but to help you understand where we are headed and what that means to the future of financial services. Because we are living through one of the most transformative periods in banking history. And I think that understanding this evolution is essential for everyone working or studying in digital finance sphere. So let's dive in and let's explore how banking moved from brick and mortar branches, so-called, to the sophisticated digital ecosystems we see today. The next slide. First of all, let me take you back to a pivotal moment of banking history, which is the year 1967. Exactly on June 27th, at Barclays Bank branch in Anfield, London, something truly revolutionary happened. And the world's first ATM was unveiled, and it was opened by actor Greg Varney, who was a local celebrity at that time. So, and really, I find this moment absolutely fascinating because it marks, to my opinion, the true beginning of self-service banking. And for example, you see before this innovation, every single banking transaction required you to physically interact with the bank teller during very limited business hours, and typically between 10 a.m. and 3 p.m. on weekends. So can you imagine that restriction today? No, I think. So, and the inventor, John Shepherd Barron, actually came up with the idea while taking a bath. Yeah, it's ridiculous. After he arrived at his bank 1 minute to, and he was late and found it closed. And he thought about chocolate bar dispensers and wondered why the same mechanism couldn't dispense cash instead. For example, and the first ATM could only dispense a maximum of 10 pounds at a time in England. And customers had to purchase a paper voucher in advance, impregnated with a slightly radioactive isotope, carbon-14, which they inserted along with the PIN pin. And what really strikes me as particularly revolutionary is that this simple innovation laid the groundwork for all the digital banking services we take for granted today. Then came the 1980s, and another breakthrough emerged with the phone banking. For example, Girobank in the United Kingdom established the first dedicated telephone banking service in 1984. And it was marking a transformational moment. And because for the first time in history, people could check their balances and conduct basic transactions without leaving their homes. And what I would like you to understand is that these weren't just technological innovations, because they really presented a fundamental shift in how banks viewed customer services and accessibility. And they were first steps toward the 24/7 banking world we live in today. Next slide. Now let me share with you what I consider one of the most transformative moments in banking history. For example, in 1994, Security First National Bank launched in Atlanta, Georgia, in USA, becoming the world's first internet-only bank. So I can tell you, it was met with tremendous skepticism at that time. And many people, for example, simply couldn't imagine trusting their money to something they couldn't physically visit. And the very idea seemed radical, almost reckless to, say, traditional bankers. And what's particularly interesting about this period is how slow the initial adoption was. And for example, let me put this in perspective for you. Say in 2001, only 30% of US adults were using online banking. And it was really the main concern. And what was the main concern? First, security, website stability, and those painfully slow dial-up internet connection they had before. So can you imagine waiting several minutes just for your bank's homepage to load? But what happened as broadband internet became more widespread? For example, in 2008, that number just jumped to 68%. And that's more than doubling in just 7 years. And therefore, this dramatic shift wasn't just about faster internet speeds, it was about a fundamental change in how people view digital financial services. And here's something else that dramatically changed the landscape, and this is critical to understand, really critical. For example, the Czech 21st Act in 2003 in the United States gave digital images of checks the same legal standing as physical paper checks. And why was this so important? So, well, it paved the way for one of the most convenient features we have today, which is a remote check deposit. Because before this legislation, everyone had to physically visit a bank to deposit a check. And banks had to physically transport millions of checks across the country every single day. And this legal change was absolutely crucial in moving banking into the digital age. And by 2005, we hit another significant milestone. For example, over 50% of all banks were offering online bill pay services. And this wasn't just about convenience, it was about fundamentally changing how people managed their money and conducted their daily financial lives. Next slide. And now, by this slide, let me tell you about what I consider the most significant shift in banking since ATMs, which is mobile banking revolution. And here, the real tipping point came in 2013 when global smartphone adoption crossed the 50% mark. But what's truly remarkable is where we are today, because as of 2025, the current year, we're seeing 72% of US adults using mobile banking apps, which is a dramatic increase from 65% in 2022, for example, and just 52% back in 2019. And for example, when I look at these numbers, I see not just another channel for banking. This represents a complete reimagining of how people interact with their money. And now, here's what fascinates me about this transformation. For example, by 2025, we have 2.17 billion people globally using mobile banking, and that's a 35% increase since 2020 alone. And if we look regionally, Europe is actually leading with 76% mobile banking penetration, with the Scandinavian countries exceeding 87%, and China has over 860 million mobile banking users, making it the largest national base by far. And even in emerging markets like Nigeria and Turkey, we are seeing adoption rates of 82% and 85% respectively. And what really drove this revolution was a specific feature. It was a remote deposit capture. So we can think about how transformative this was, because you could suddenly deposit a check while sitting on your kitchen table and just by taking a photo with your phone. And this wasn't just convenience, it was a fundamental shift in how people thought about banking, because by 2016, when we had nearly 3 billion smartphone users worldwide, over 80% of the banks had developed their own mobile apps, and remote deposits was the killer feature for them. And here's something crucial that often gets overlooked, because regulators played an absolutely essential role in this revolution by actively developing mobile banking security guidelines. Because this wasn't just regulatory oversight, it was about building consumer confidence, actually, and people needed to trust that their money was safe before they would embrace banking on their phones. And that just was fundamental to the explosive growth we've witnessed today so far. Next slide. And now, this is where things get really interesting, the emergence of what we call neobanks or digital challenges. So let me tell you about companies like Simple, Chime, and Robinhood, for example. These weren't just new banks, they were completely reimaginings of, say, what banking could be. Because what made them special? They started with a mobile-first mindset from day one, targeting younger customers who wanted banking to be intuitive, as using social media, for example. And the scale of this disruption is absolutely remarkable, because as of today, we are seeing explosive growth in the neobank sector. For example, in the United States alone, Chime and Faro combined reported revenues of $4.8 billion this year. And Revolut, for example, the leading European neobank, achieved 2.1 billion in annual revenue and 180 million in profit as well. And even more expressive, Revolut is now valued at $75 billion, and it is making it the highest valued neobank in the world as of September 25, as of today. And digital-only banks, so-called digital-only banks or neobanks or challengers, now serve over 53 million customers in the US alone, and globally we have around 400 million neobank users. And that's a dramatic increase from just a few years ago. Because in fact, for example, for about 54% of global bank customers have switched to digital-only banks in 2025, and it's absolutely transformative, I would say. And what is particularly interesting is how the challenges force traditional banks to respond. For example, if we take Chase, they launched Finn, their own digital-only bank, and Citi did not the same. Citi really did the same with Citigold. And why? Why that happened? Because they saw these neobanks weren't just taking customers; they were fundamentally changing customer expectations about what banking should be. And these, therefore, these neobanks had a completely different approach. For example, no branches, no legacy systems to maintain, and most importantly, no traditional banking mindset to overcome. And they focused on what younger customers wanted, which is high interest rates, zero fees, digital experience that actually made sense. That's all. Next slide. Now let's review another game-changing moment in digital banking, which is the launch of Venmo in 2009. And this might seem like just another payment app now, but it completely transformed how people think about sending money to each other. And it is really remarkable about this development that is the sheer scale of the transformation we've witnessed since then. And by 2021, peer-to-peer payment apps were handling over $175 billion in transactions. But therefore, let me update you on where we stand today in 2025. And these numbers are absolutely staggering. For example, Zili has surpassed $1 trillion in total transaction volume in 2024, and making it the highest ever recorded for P2P payment platform. And also their user base expanded to 151 million accounts with a 27% increase in total funds transferred year over year. And this truly remarkable growth. And also Venmo continues to dominate in terms of marketing engagement, with payment volumes rising over $325 billion in the current year. And that is particularly impressive, that Venmo captured for about 81% of all US P2P digital wallet transactions this year, because they have appropriately about 95.4 million active accounts, and their monetized monthly active users grew by 24% in 2024. And what is interesting from my perspective is that P2P payments represented something entirely new in the current year, because this wasn't just digitizing an existing banking service. It was really creating a completely new way to move money that bypassed traditional banking channels entirely. And for example, before Venmo, Zelle, and similar apps, if you wanted to pay someone back for dinner or split a bill, you needed cash or a check, or I don't know, or had to go home or had to go through a complicated bank transfer process. And now it's as simple as a few taps on your phone. So, and the global P2P payments market is now valued at $10.3 billion in 2025, and it is expected to reach 20.42 billion by 2033, and it is growing at a compound annual growth rate of almost 13%. You can imagine, and this is a really perfect example of how digital innovation isn't just making existing services more convenient, but it's creating entirely new possibilities in finance that are fundamentally changing how money moves between individuals. The next slide. And now let me talk about what I believe is one of the most transformative developments in modern banking, which is open banking revolution. And the catalyst for this massive change was the introduction of regulations, particularly PSD2 in Europe, which was implemented in 2018. And now we consider it as very important. And why? Because the first time in banking history, banks were required by law to share their data and capabilities with authorized third-party providers, providing customers gave them consent. And this ended banks' centuries, because they now cannot control over all of the customer data. And what is really good about this is how fundamentally it's reshaping the relationship between banks and innovation, because through APIs and aggregated tools, we are witnessing an explosion of new services that can analyze your spending patterns, automate your savings, and provide personalized financial advice in ways that were simply never possible before. And moreover, the numbers tells a compelling story here. For example, in the current year, we're seeing for about 137 billion open banking API calls globally, and this is really projected to surge 427% to reach, I think, for about 720 billion by 2029. And this is really absolutely stage rate of growth, I think, I consider. And what is almost interesting is the regional variation in adoption. Because, for example, the UK leads with over 13 million open banking users as of 2025, followed by Germany, Sweden, and France. And in fact, Germany has become actually the second most major open banking market in Europe. And the Berlin Group developing the widely adopted next-gen PSD2 API standard. So, and we can think about it in the following way. Traditionally, banks kept all their data and services locked away in proprietary systems, but with open banking, we are removing that, and we are going towards what I call banking ecosystems, because your financial data can now flow seamlessly between different services and enabling new forms of embedded finance and fintech collaboration. And research from, for example, Spain shows that after PSD2 implementation, fintech companies specializing in payment services improved their performance significantly, which was driven primarily by revenue growth. And this also reduced their reliance on long-term bank debt and secured more stable market equity funding as well. And finally, this isn't just about making banking more convenient. It's about reimagining what banking services can be. Because from my experience working with these technologies, I can tell you that that weren't only scratching the surface of what possibly may be with open bank. Next slide. And now let me share with you how digital banking is breaking down geographical barriers in truly remarkable ways. So when I look at the global money movement landscape, the numbers are absolutely staggering because, for example, let us take services like TransferWise, which is now known as Wise simply, and for example, Western Union are now, all of these services are now handling massive volumes of cross-border transactions. And in fact, global remittance flows reached $905 billion in 2024, representing a 4.6% year-over-year growth. And for example, Wise alone transferred $145 billion in their physical year of 2025. Demonstrating the dramatic shift toward digital remittance services. And what is particularly exciting is how 67% of remittance senders now are using digital platforms, it shows, as to my opinion, a fundamental transformation from traditional money transfer methods. And for example, digital wallets such as Wise and Revolut processed over $60 billion in remittances in 2025. And this shift is significantly reducing cost for consumers. And also, the World Bank has set an ambitious target to lower global remittance costs to 3% to support low-income countries through, and though we are currently averaging around 6.5% globally. But here is what I found even more transformative, which is the impact of digital banking on developing markets, particularly in Kenya, for example, because this is truly one of the most remarkable success stories in financial inclusion, because Kenya has consolidated its position as a world leader in digital financial services, achieving 91% mobile money penetration by June 25, 2025, and that's about 50 million active subscriptions in a country with a population of 56 million, which means there's more than one mobile money account per person. Please turn off your mic if you would like to ask anything.
And it's non-mathematics data. That is a correlation. know what I said.
Adrian, please. Yeah, thank you. Okay, let's go on. What I find even more transformative is the impact of digital banking in developing markets, particularly in Kenya. For example, you may know about the Kenyan application M-Pesa, which was launched in 2007, has completely revolutionized financial services in Kenya. And the statistics are really mind-blowing because Safaricom reported for about 28 million M-Pesa transactions for the financial year ending March 2024, up to 34% from the previous year, valued at 40 trillion Kenyan shillings, which is approximately 309 billion US dollars. And M-Pesa currently holds for about 91% of the market share in Kenya's mobile money space, which is over 66 million customers across Africa. And what strikes me most about M-Pesa's success is how it's brought banking services to populations that traditional banks never reached. Because research shows, for example, that almost 77% of informal sector entrepreneurs in Kenya received more than half of their business revenue via mobile money. And this isn't just about technology, it's about financial inclusion on a massive scale, which is demonstrating how mobile money is fundamentally transforming economies in developing markets. Next slide. Okay, now let's share something that keeps traditional bankers up at night, we would say, because it is the aggressive entry of big tech companies into the financial services arena. So when we look at the partnerships between tech giants like Google, Apple, and even Goldman Sachs, digital wallets and credit cards, so we are witnessing a fundamental shift on the competitive landscape of banking. And here is a statistic that really brings this into sharp focus. For example, for about 95% of banks fear of losing their business is due to these tech giants, actually. And honestly, they have good reason to be worried, I think, because we can think about the advantages these companies bring to the table. Because, for example, Apple Pay processes almost $9 trillion in global transactions in 2025, and with almost $3 trillion in the US alone. And for example, Google Pay handled 5.2 trillion globally and reaching 1.4 trillion in US-based transactions. And these aren't small numbers, actually, as you can guess, because they represent a massive shift in how payments are being processed worldwide. And that makes it particularly fascinating as to me. And that is how deeply integrated these payment systems have become, actually, because Apple Pay is now being accepted by 92% of major US retail chains, while, for example, Google Pay has reached 83% merchant acceptance as well. And by now, Apple Pay is projected to account for 10% of global card transactions, and the adoption rate among users is remarkable, really, because for about 68% of users find Apple Pay faster for in-store payments, for example. And these platforms have achieved PCI DSS level 1 compliance also, and which is representing the highest level of payment security. Indeed. But what really sent shockwaves through the banking industry was Facebook's exploration of its own cryptocurrency, as you may know, because their project initially called Libra and later renamed Diem was announced in 2019 as a global payments network designed to be highly scalable and secure. And Facebook's mission was ambitious, actually, because it was to develop a financial infrastructure that would empower billions of people worldwide. However, the project faced intense regulatory scrutiny and ultimately wound down in early 2022 after it became clear from dialogue with the federal regulators that it couldn't move forward. And the Diem Association sold its assets to Silvergate Capital Corporation for $182 million. And what is significant, what I find significant here about these tech giants' payment ambitions is how they are blurring the lines between technology and banking. Because these companies already have billions of users and they have deep insights into customer behavior, and they have incredibly sophisticated technology platforms, and they have something banks desperately want. That is a deep daily engagement with customers and mastery of user experience. And they are leveraging these advantages to fundamentally reshape the future of payments and banking. Also, next slide. Now, by this, let me share with you three key developments that I believe are revolutionizing how we manage our money on a daily basis. And these aren't just theoretical concepts, so they are actively changing the financial lives of millions of people right now. First, let's talk about predictive analytics. So, what is fascinating about this is how it can actually forecast potential cash shortfalls, for example, before they happen. For example, recent research from 2025 shows that predictive analytics has a significant impact on customer personalization, with the studies revealing it accounts for 73.7% of the variance in personalized banking experiences. And here's what is interesting: over 50% of customers are actively seeking these kinds of insights because they want their bank to be proactive, not reactive. So, and therefore, banks are now using AI-powered systems that analyze behavioral and transactional data just to generate actionable insights that optimize customers' lifetime value, so-called LTV. And this means your bank can anticipate when you might need a loan, when you are likely to face unexpected expenses, or even when you might be at risk of overdrawing your account also. And then we have auto savings tools, which I consider one of the most impactful innovations in personal finance. Because now let me a little bit explain why these tools take the psychology of saving money and automate it. Because, for example, apps like Plum and Moneybox use AI algorithms to understand your spending habits and automatically move money to savings based on your personal goals instead of relying on willpower. So they really work in the background, continuously learning from your financial behavior. And what's remarkable is that these apps can even save when you are just in your overdraft, for example, setting barriers to avoid unarranged overdraft fees. It's like having a personal financial assistant working 24/7, and the adoption has been tremendous in 2005 currently. And finally, that's automated bill pay. So it might seem simple, but it has fundamentally transformed how we handle recurrent payments, because, for example, before automation, you had to remember every due date, manually initiate each payment, and manually keep track of everything yourself. But it all happens seamlessly in the background. And according to the current year banking trend, AI-driven automation is enabling predictive customer service through so-called data-driven insights and reducing operational costs via automated workflows. For example, here, banks that are successfully implementing these systems, they are seeing significant improvements in both customer satisfaction and operational efficiency. And finally, from my experience working with these technologies, I can tell you that automation isn't just about convenience, so it should be about fundamentally changing our relationship with money management. And we are moving from reactive financial management to proactive intelligent systems that work on our behalf. Next slide. And let me walk you through three developments that are transforming how banks interact with their customers nowadays. So these, this is not a theoretical improvement. So there are fundamental shifts in how banking relationships are being built and maintained. So first, let's talk about data analytics and personalization. And this is very exciting indeed, because banks can now understand their client at an unprecedented level of depth, because it's not just about knowing what services customers currently use. It's about predicting what they might need before they even realize it themselves. Sounds like a Black Mirror. And recent data from the current year investigation shows that almost 74% of failures in personalized banking experience can be attributed to predictive analytics. And banks are now able to use AI to analyze behavioral and transactional data in real time, creating what we call micro personalization. And this really means that instead of sending the same credit card offer to everyone in a demographic group, banks can now deliver contextually relevant messages at the exact moment a customer is, for example, most likely to need that specific service. And the second transformation I want to highlight is social media integration, which has completely changed the game in terms of customer service and marketing. Because here's something that might surprise you, for example, and that is that for about 90% of the top 100 US banks are now active on platforms like Facebook. And this isn't just about posting content. So banks are providing real-time customer service through social channels. And what is particularly interesting is that 73% of social users say they will buy from a competitor if a brand doesn't respond on social media, for example. And the current research from the current year indicates that customers want personalized customer service to be the number one priority for brands on social media. And the quality of social media engagement matters more than volume, even, because recent findings show that banks posting less frequently, but with high quality content, are actually seeing better results. And this also reflects evolving customer priorities, because nowadays they want meaningful interactions, not just promotional messages. And for example, studies confirm that social media brand engagement has a significant relationship with customer loyalty, especially in the banking sector. And finally, let's talk about targeted marketing through data-driven strategies. So what is of the most interest here is that how banks have moved beyond generic mass marketing to deliver, say, highly personalized offers based on actual customer behavior and preferences. It's not just more effective, it's transformative indeed. And for example, banks can now identify the optimal timing for cross-selling opportunities, or they predict customer needs with remarkable accuracy and deliver offers that align precisely with each customer's financial journey. And the results are really striking, because banks implementing advanced customer analytics see significantly stronger campaign performance and high engagement rates and improved customer lifetime value as well. Next slide. And now let me share some sobering statistics with you. For example, in 2020 alone, $16 billion was lost to bank fraud, due to bank fraud. And this is precisely why security has become absolutely critical in digital banking. And I want to walk you through three key developments that are revolutionizing how we protect customer assets. First, let's talk about biometrics. And the numbers you can see here are truly remarkable. For example, by the current year, the global biometric payment market has reached for almost $46 billion, demonstrating the massive scale of adoption we are witnessing. And this is really impressive that 83% of consumers worldwide now perceive biometric payments as safer than traditional PINs or passwords. And over, for example, 2 billion biometric payment transactions projected to occur globally in 2025. And approximately 70% of financial institutions in the US have integrated biometrics into their payment systems this year. And the technology itself has evolved significantly. But for example, facial recognition now accounts of 62% of biometric payment methods in use worldwide. And its adoption grew by 50% globally in 2025, and which is even more remarkable, 1.4 billion people worldwide are using facial recognition for payments authentication in the current year, for example, compared to just 671 million in 2020. And that's, by the way, that's more than doubling in 5 years. And what fascinates about me about biometrics is how it's turned something as unique as your, for example, fingerprint or face into a key that unlocks your banking app or something else. And it's actually more convenient for customers, which is a rare win-win in the security world. And next, let's discuss cybersecurity and fraud detection, which have become actually increasingly sophisticated. And as digital banking capabilities grow more advanced, so do the risks from hacking. It's understandable. And also fraud and cyber attacks as well. And from my experience working with banks, for example, I can tell you that cybersecurity, it's not about preventing attacks, it's about detecting and responding to threats in real time. Because, for example, AI-driven biometric fraud detection implementations rose by 45% in the current year across finance and payment systems. And for example, banks are now using behavioral analytics combined with biometrics in order to stop fraud attempts within 5 milliseconds even. So, and it really offers real-time protection. And the investment here is massive indeed, because it exceeds $2.3 billion in the current year, but it's absolutely necessary to protect customer data and transactions. And finally, let's discuss security connections, and also let's discuss encryption protocols. That is really interesting, as to my opinion, because here it is interesting how encryption technology has evolved to protect every single online banking session, because we can think about every time you check your balance or make a transfer, your data is being protected by encryption that's now used by 68% of financial institutions to comply with the data protection laws. This includes advances like ultrasonic finger trip sensors that improve detection accuracy even with a wet or dirty fingers, and 3D facial mapping technologies driving security advanced contactless biometric payments. And this is actually at the level of protection required in today's digital banking environment, where threats are constantly evolving. Next slide. Let's talk a little bit about a really exciting development in digital banking that's transforming how customers interact with their financial institutions, which I call a conversational AI. It's primarily it was implemented through chatbots and voice assistants as well. But now it has become a game changer in the banking industry. And what is really interesting is that, for example, 86% of banking customers either already use or want to try these conversational interfaces for their basic banking needs. And we can talk, for example, about what makes this so transformative, because recent research from the current year shows that the integration of chatbots has created a strong positive relationship between operational efficiency and customer trust, with also correlation coefficients of 0.6, which is rather high. And what this means in practical terms is that when chatbots work efficiently, customers trust them more. And this significantly predicts overall user satisfaction. And in fact, operational efficiency and customer trust, altogether, they explain almost 56% of the variance in customer satisfaction, and intend to use these systems as well. And here's what really excites me about conversational banking. It's not just about automation anymore. So in 2025, we are seeing AI assistants that can understand tone and intent. And for example, they can speak multiple languages, learn from past conversations, and even proactively solve problems before customers realize they have them. It's impressive. And the voice AI also is projected to reach, and its market is projected to reach $47 billion by 2034, and with 8.4 billion voice assistants already in use globally. So we can think about the practical applications here, because instead of navigating through multiple menu screens on your banking app, for example, you can simply ask, what's my balance? Or did my salary get deposited? Or and the system in that case understand natural language and response instantly. What's practically impressive is that 37% of US customers had already interacted with their bank's chatbots by 2022, and this number is growing significantly each year. And also, the technology has also become remarkably sophisticated with voice banking, for example, because banks are now integrating voice assistants across mobile apps, smart speakers like Alexa and Google Assistant, and IVR systems as well. And for example, according to the recent projections, the number of voice assistants in use is expected to reach 12 million by 2030. And this can be the more powerful, and what makes it the more powerful is the integration of voice biometrics for security. Like, for example, banks like HSBC can now verify customers in seconds using their unique vocal patterns, eliminating the need for PINs or even passwords. Well, folks, we now have a break.
Excuse me, interruption.
Yes.
I have a question about the AI. Do we have any information, like, for example, on India or China? It is clear that it's quite advanced in Russia, all the paying with a smile thing, and also other things with banking. But what about other countries? Like, I know that somewhere it's not as used as often like it is.
Yeah, sure. Yeah, thank you for your question. It's really interesting. So I have not, honestly, frankly speaking, I do not have ready statistics just in front of me, to my sorrow, but I can prepare it later on. But nevertheless, so I would say that there are two cases here. The first case is whether the country or a region we're speaking about, for example, whether it has its own conversational engines. Like in Russia, for example, we have very good, very advanced conversational engines from Sberbank, like Salute, for example, and from Yandex as well, and a few others. What do I mean? Special languages like Chinese, for example, or Hindi, they so you might have to spend a lot of resources to train your neural networks and your conversational agents for engines for these languages, for example, and Russian as well. and that is why and you have to process a lot of hours, millions or billions of hours of the conversational speech, real live speech on the appropriate language through these networks, and that is why I think first of all that depends on the existence of the local speech engine, for example, in the country like India or China. I do believe actually that in China they have a few appropriate conversational agents, and therefore it may be spread off in China, no doubts. But through, for example, the agents of such providers like Tencent or Alibaba and so on. But in India, I do not know, honestly saying so, but I can get this information later on. And all over the world, I think that, but taking into account that many of the people in India speak English, I think that not might be a problem, for example, to use conversational engines, conversational banking or conversational agents in India, like in English-speaking country, and therefore I guess that in India it's spread out as well, like in China, for example. Another question whether it's comfortable to use for the people or whether the majority of people use it, for example, on a daily, day-by-day basis. I don't know actually. But another case is the first one. Another case, you should take into account the spread of the so-called voice assistants in this country. For example, even foreign ones, for example, like Alexa or like Yandex, Alisa, for example, yeah, or Google Assistant, for example. Taking into account that these big four technological companies like Google, Amazon, who have actually their own voice bots or conversational gadgets. So they are very interested in the local Indian markets, and they are developing their own local business very intensively. Therefore, I also guess that it's not a problem to buy a voice assistant or any voice assistant gadget from Amazon, for example, Google in India, and to use it for banking as well. And in China, so they have a very closed market, as you know, and therefore they use their own gadgets for this purpose. But I know that Alexa is very spread out in the United States, for example, and they use it very intensively. But another case here is how secure to use, for example, voice agent, separate voice gadget or voice agent for the purpose of the conversational banking. I know that many banks doubt if that is secure enough. For example, I know that there were several attempts actually to start conversational banking in Russia or in USA, but it has been found actually not secure enough to allow clients to perform their own transactions on the base of their voice. Therefore, I know that in the majority of times, the voice engines or voice assistants are being used for the security, for the authentication purposes, for example, not for performing transactions. And therefore, sorry for this abstract answer, but I really need to prepare myself for the next lecture in that terms. And thank you for your question.
Thank you very much, Professor.
Yeah, but your question is very good, and I have fixed it, and I will turn back to it once again for sure. Yeah, okay, guys. So let's make a break just for five minutes. Yeah.
Hello, Professor.
Yes, yes, sure.
Okay, please, can you share the grading system? I was not in the first class, so my course started today. I just started today, so I would like to see the grading system.
I'm really sorry. So the sound is very bad, actually. Could you write it down in the chat?
Okay, what I'm
I do not
asking
I
is
do not hear you well.
okay, can you hear me now?
Please, yeah, please write it in the chat. Yeah, sorry. Thank you.
Okay, it's okay.
Okay, we are getting back. Yeah, I see a question, Joseph. Thank you. About the grading system. So, as I know, so they have to provide you with the syllabus, with the study program. So if not, I can send it separately after the lecture, and you can find the grading system description in that program. And moreover, you can find it on the Smart LMS web page as well. And there is a distinct differentiation of the distant divide of the grade. But nevertheless, if you do not find it, for example, I can provide it separately to the dean's office, say, just to let them send it to you. Okay, let's go on. The next slide. And now let's explore another fascinating innovation in digital banking that is bringing a human touch to remote services. So I call it video banking. And this technology is particularly interesting because it bridges the gap between traditional face-to-face banking and digital convenience. And the adoption rates have been remarkable, actually. And what I find particularly compelling about this trend is the ambitious adoption we've witnessed. Because our data shows, for example, that approximately 2/3 of banks plan to improve video banking services by 2020. And by now, 2025, this technology has matured significantly. Because according to recent market analysis, remote advisory services represent the fastest growing application segment within video banking in terms of revenue, and as customers increasingly prefer receiving financial guidance from their comfort of their homes while still maintaining the trust and relationship building crucial for financial decisions. And I would say that the beauty of video banking lies in its ability to replace the personal touch of face-to-face meetings while offering unprecedented convenience. For example, we can think about complex financial discussions like mortgage applications, investment planning, and or wealth management for example. And these traditionally required in-person meetings at a branch, but now through secure video connections, customers can have the same high-quality consultations from anywhere. For example, leading banks implementing remote advisory at scale have been upwards of 40% of customers voluntarily switching to this service. For example, and net promoter scores, for example, of these banks are improving by up to 20%. And what is really impressive about this is how the technology has evolved actually, because modern video banking platforms now integrate high definition video and security document sharing, for example, electronic signature capabilities, co-browsing and screen sharing, and all within a seamless encrypted environment. And banks can now easily collect KYC documents, can easily transfer leave documents, and provide step-by-step guidance through complex financial products, all while maintaining the highest security standards, including GDPR or CCPA or GLBA compliance, and so on. And from a business perspective, the results are also striking, because some banks have seen advisor productivity double, and with both sales and assets under management per advisor increasing substantially, while, for example, the cost to service plummets. And what's emerging is a three-tier model here. Roughly 1/3 of customers still prefer an in-person advisory services through branches. 1/3 are happy with purely digital channels, and the final third are adopting the remote advisory models, capitalizing on the convenience and specialized expertise it provides. And hereby, I would like to emphasize two crucial advantages. First, video banking significantly improves the quality of remote service delivery, because clients can see and interact with their advisors in real time, building, for example, trust and rapport. Second, it enhances security, because both the bank and the customer can verify each other's identity visually, and adding an extra layer of confidence to remote banking relationships. And this is particularly valuable for example, high value transactions or complex financial discussions where building trust is really crucial. Next slide. And now let's walk through three groundbreaking applications of artificial intelligence and machine learning that are really revolutionizing banking services. Because these technologies aren't just buzzwords here anymore. So they are fundamentally changing how banks operate and serve their customers. First, let's talk about predictive analytics and the expansion of computing power. Here, what is remarkable here is that we're now able to process vast amounts of data in real time. And this is enabling intelligent alerts, for example, and automated services that anticipate customer needs before they arise. And for example, research from the current year shows that the predictive analytics now accounts for a 74% variance in personalized banking experience, and banks are using AI to analyze behavioral and transactional data, generating actionable insights that optimize customer lifetime value. And for instance, these systems can now predict when you might face a cash shortage, for example, when you are likely to need specific banking services, or even when you might be at risk of churning to a competitor. And the second critical application is in risk management and fraud detection as well, because machine learning has become absolutely essential in identifying and preventing fraudulent activities. And what is fascinating about these systems is their ability to continuously adapt and learn from new types of fraudulent patterns. because recent studies, for example, demonstrate that AI-powered fraud detection using machine learning algorithms like LSTM or SVM with random mount sampling, for example, achieves recall rates of almost 90% and so-called F1 scores exceeding 91.5%. And this system can analyze over 1,000 data points per second, for example. And they may detect, for example, anomalies and reducing portfolio losses by approximately 12% during volatile market periods. And currently, the integration of AI-driven biometric fraud detection rose by 45%, with systems now capable of stopping fraud attempts within just 5 milliseconds. And the third application, which I find particularly exciting here, is investment optimization through AI-powered platforms. For example, currently, AI-powered robo-advisors now they manage over $1.26 trillion in assets globally, and they represent truly explosive growth. And these platforms, they analyze market data and customer preferences simultaneously in order to provide personalized investment recommendations and in order to optimize portfolios in real time. And they can do that continuously on the base of 24/7. I mean, in terms of monitoring portfolios and enhancing returns by approximately 15% annually. Therefore, for example, robo-advisors charge substantially lower fees, typically for about 0.2% to 0.3% compared to traditional advisors, making it sophisticated investment management accessible to a much broader demographic. Approximately 60% of robo-advisors users now come from middle income brackets, and this is demonstrating true democratization of wealth management services. And for example, from my experience working with these systems, I can tell you that they are significantly improving investment outcomes while also reducing the time and effort needed for portfolio management. And also the combination of predictive analytics, advanced fraud detection, and these kind of intelligent investment optimization altogether represents a quantum leap in how banking services are delivered. Next slide. And now let us talk about the blockchain and cryptocurrency, because they are really reshaping the banking industry nowadays. First, let's talk about blockchain technology itself and its impact on infrastructure costs. The recent research demonstrates that banks implemented blockchain solutions could reduce their infrastructure costs by up to 30% through efficiencies like streamlined settlement and automated processes. And what we are seeing here is that financial institutions using blockchain-based payment solutions have really recorded cost reductions ranging from 40% to 70%, up to 70% compared to traditional methods. And for example, studies show that blockchain adoption significantly reduces processing costs and transfer costs and fraud costs simultaneously. And for example, for cross-border payments specifically, the savings are even more dramatic. For example, traditional systems like SWIFT involve multiple intermediaries with fees ranging from 5% to 20% of the transferred amount. And for example, blockchain enables direct peer-to-peer transactions, eliminating these intermediaries. And blockchain payment systems, for example, have reduced the cost of international money transfers by 40%, saving consumers and business over $10 billion. And also, the world's largest investment banks are expected to lower their operational cost by $8 to $12 billion annually by 2026, which represents approximately 25% of their operational expenses. And now, when it comes to cryptocurrency, I would like to be clear about something that's crucial to understand, because while Bitcoin was the first major application of blockchain technology and captured public imagination, I think that it's not necessarily the most important development for banking's future, because what is truly revolutionary is the concept of decentralized digital currencies and the underlying technology as well. Because the recent analysis shows that cryptocurrency banking offers faster transactions and significantly lower costs. For example, through regulatory and through liquidity challenges persist. But meanwhile, central bank digital currencies, for example, provide a balanced approach by combining digital efficiency with the government-backed financial stability. And the third aspect I'm particularly excited about is smart contracts. So, because these self-executing contracts built on blockchain technology are truly revolutionary, because they automate complex financial agreements without even requiring intermediaries. So, and we can think about, for example, loan agreements or insurance policies or trade finance contracts that automatically execute when predefined conditions are met. And for example, today, the banking sector leads smart contract adoption with approximately 48% of all use cases. And for example, in trade finance alone, these kind of smart contracts have reduced processing times by an average of 31%, and therefore saved companies over $2.5 billion in administrative costs through the elimination of paper-based processes. And also, 85% of global financial institutions are now expected to adopt smart contracts in some form by 2025. And also, the comprehensive analysis shows that smart contracts could reduce financial infrastructure costs by 30% through streamlined processes and disintermediation, I would say, while simultaneously enhancing transparency and regulatory compliance through automated execution. So this is incredible as to me. The next slide. Okay, now let's talk about how cloud technology is revolutionizing banking operations. And the numbers here are quite remarkable. For example, by 2026, cloud migration could reduce bank costs by up to 30% through consolidated systems. However, what I find here particularly interesting is that this isn't just about cost savings, so it's about transforming the entire banking infrastructure. Because, for example, if we break down what's actually happening in 2025, we could say that among financial institutions, almost 61% report that cloud adoption has either significantly or marginally reduced their total cost of ownership for IT infrastructure. And more specifically, US banks are cutting IT costs by up to 40% by, for example, adopting cloud-native cores and representing a dramatic shift from legacy infrastructure. And for example, banks using cloud-based AI agents can handle data entry and deposit origination at scale and automatically routing complex cases to human bankers while providing real-time client recommendations during customer interactions. And the real power of cloud technology here lies in its ability to enable advanced analytics and simplified scaling, I would say. Because, for example, banks can now process enormous amounts of data, and they can quickly deploy new services without the traditional infrastructure constraints. And for example, by now, 55% of banks have also shifted at least 30% of their critical workloads to the cloud. And therefore, cloud migration has led to a 15% increase in revenue for banks leveraging advanced customer engagement tools, for example, and automated updates save also financial institutions an estimated of 3,000 hours annually. And what is also fascinating about all of this is the evolution toward hybrid and multi-cloud strategies. For example, currently, for about 68% of financial firms are utilizing a mix of public and private clouds in order to optimize costs and compliance. And this diversification approach reduces risk while optimizing performance by distributing workloads across multiple cloud environments. And for example, banks that have invested in cloud capabilities, they are really seeing real returns, because some clients have significantly grown their deposit and its base by leveraging, for example, digital and cloud technologies, with, for example, one case nearly doubling deposits over 5 to 6 years by adopting a cloud-native digital banking platform. However, I need to emphasize that the challenges that still exist here. Because while 77% of banks plan cloud adoption, security doubts and compliance requirements also around data resiliency, for example, they are continuing to slow implementation efforts. Because different countries have varying regulations about where customer data can be stored and processed. And this all is creating a complex puzzle for international banks. And this is particularly challenging for global institutions trying to implement unified cloud solutions while maintaining compliance with the diverse regulatory frameworks across jurisdictions. And from my experience also, working with banks on cloud transformations, I can tell you that the success requires partnering with the right ecosystem players, because cloud providers that understand in banking or core technology vendors with a proven track records and consultant partners who've navigated banking transformations before, and banks that thrive aren't necessarily those who with the biggest technology budgets. So they are the ones that understand they can't do the transformation alone. Next slide. And now let me share a critical insight about the state of digital banking that often goes unnoticed. So while many banks showcase impressive consumer-facing digital solutions, the reality behind the scenes is quite different. Because, for example, would you believe that only 13% of banks currently have truly end-to-end digital operations? And this statistic reveals a significant gap between what customers see and what's happening in the back office. And from my experience, for example, working with the various financial institutions, I've observed really that the main challenge lies in the integration of legacy systems, because many banks are operating with what I call a technological patchwork. So it means different systems for core banking, for payments, lending, and other services that have been accumulated over decades. And these systems weren't designed to talk to each other, for example, and yet they need to work together seamlessly in today's digital environment. And moreover, here, one of the main challenges that you can't simply replace these systems overnight, because they are processing millions of transactions daily, managing crucial customer data and maintaining regulatory compliance. And it's like trying to change the engine of an airplane while it's flying. So it requires careful planning, precise execution, and a clear understanding of the risks involved. And this is why I believe the digitization of back-end infrastructure is perhaps the most crucial challenge facing banks today. And moreover, without modernizing these fundamental systems, banks will struggle to deliver the seamless and integrated services that customers increasingly expect, because the banks that succeed in this transformation will be those that can effectively bridge the gaps between legacy infrastructure and modern digital capabilities, creating truly unified systems that, for example, enable innovation while simultaneously maintaining the stability and security that banking requires. Next slide. And now let me paint a picture of how modern banking customers interact with their financials. One of the researchers shows that 73% of clients use multi-channels for their banking needs, which are a statistic that fundamentally changes how we need to think about service delivery currently. Because this isn't a small segment we're talking about, and this is the clear majority of banking customers. So let me break this down into three critical aspects. First, there is flexible access across platforms, and for example, today's customers expect seamless banking experiences across every possible touch points, whether they're using their smartwatch to check balances, their smartphone to make payments, and their laptop for detailed financial planning, or even visiting a branch for complex advisory services. And what's particularly interesting in the current year is the explosive growth of wearable banking, so-called wearable gadgets for banking. Because wearable device shipments with the payment capabilities have reached just over 570 million units globally this year. And for about 54% of mobile banking users now access services via smartwatches, seeking seamless, for example, hands-free banking for everyday transactions. And also, the wearable payments landscape is dominated by NFC technology, near-field communication, which holds a massive 67% of market share, making it the backbone of contactless transactions. For example, fitness-focused wearables with embedded payment technology account for approximately 42% of the market in 2025. And also biometric authentication, particularly facial recognition, now powers 68% of wearable payment transactions, ensuring both convenience and security. And the second aspect, which I find particularly fascinating, is omni-channel integration, because this goes beyond just having multiple channels. So it's about creating a unified system where all these channels work together seamlessly. For instance, a customer should be able to start a loan application on their mobile app during their commute, continue it on their desktop at work, and complete it during a video banking session with an advisor, for example, and all without having to repeat any information. And for example, the Internet of Things in banking market also demonstrates these integrations, standing at almost $40 billion in 2025 and projected to reach now $180 billion by 2030, advancing at a remarkable 32%, almost 33% compound annual growth rate. And IoT connected features such as smart homes and smart transit integration contributed to an estimated 12% incremental growth in wearable payment usage by 2025. And for example, about 60% of wearable payment devices now use AI-driven personalization to enable dynamic spending controls and loyalty suggestions. And for example, now we are even seeing contactless payments spreading beyond traditional points of sale, like they are being incorporated into cars, into smart appliances, and even garments, as IoT technology makes payments truly ubiquitous. And finally, let's talk about branch transformation, because despite the digital revolution, physical branches aren't disappearing, so they are evolving. And from my experience, for example, I've seen branches transform from transaction processing centers into advisory hubs. So because they are becoming spaces where customers receive personalized guidance for complex financial decisions like wealth management, like business lending, or major life event planning, for example, while routine transactions increasingly shift to digital channels. And this hybrid model represents the future because it is combining digital convenience with human expertise, exactly where it adds the most value. The next slide. And now let me take you to the frontier of banking technology, where three cutting-edge innovations are poised to reshape the future of financial services. And it's not a theoretical concept, so because they are emerging technologies that forward-thinking institutions are already beginning to explore. First, let's talk about virtual reality. While it's still in the early stages in banking, I'll say I find the potential applications fascinating because we can imagine walking through a virtual branch where you can interact with the financial data in the 3 dimensions, or having immersive financial planning sessions with your advisor without leaving your home. And for example, from my experience working with these technologies, I can tell you that VR has the potential to revolutionize customer engagement in banking. For example, creating experiences that blend the personal touch of face-to-face interactions with the convenience of remote access. And also quantum computing is perhaps the most transformative technology on the horizon, because the computational power it promises could exponentially increase our ability to process complex banking operations. And so we can think about risk calculations that currently take days being completed in seconds, for example, by the quantum systems, quantum computers, and or say AI systems that can analyze market patterns with unprecedented depth and accuracy. And what is particularly exciting about the quantum computing is, for banking especially, is its potential to solve optimization problems that are particularly impossible for classical computers, such as portfolio optimization, scale, or real-time fraud detection across millions of transactions simultaneously. And the third frontier is what we call ambient computing. And this is where embedded finance truly comes in its own. Because this concept truly represents a fundamental shift in how we interact with the banking services. For example, the global banking as a service market was valued at $18.6 billion in 2024 and is projected to grow up to 15.1% compound annual growth rate through 2034. And more impressively, global BaaS platforms revenue from account and card issuing is forecast to grow by 158% to 2028, reaching for about $94 billion from 36.4 billion this year. And what's driving this explosive growth is in the embedded finance, for example. I think it's the integration of financial services directly into everyday environments through connected devices. So you can imagine your refrigerator offering groceries and managing the payment automatically, or for example, your car handling toll payments seamlessly, or your home managing utility payments based on real-time usage. And the embedded finance market is being powered by rising consumer expectations for seamless app-based financial services integrated into non-financial platforms. For example, by 2025, we are seeing hyper-personalization become a key factor. with the digital wallets or customer cards issuance, which is allowing companies to deliver flexible financial products tailored to individual needs. And this isn't just about convenience, because it's about making banking services so seamlessly integrated that they become particularly invisible yet perfectly functional. And the future financial system won't be built in banks. It will be embedded in the apps and the platforms and services those are being used by people in their everyday life. So that's the promise of ambient computing and embedded finance combined. And now let me outline 4 key trends that I believe will define the future of digital banking. So these aren't just predictions. Because they are transformations that are already underway and gaining significant momentum, and as we move through 2025. So first, let's talk about the mobile banking becoming the dominant channel, because all indicators point to mobile not just being important, but truly becoming the primary way people interact with their banks. And this isn't surprising when you, for example, consider how central smartphones have become to our daily lives. And for example, from my observations, this shift isn't just about convenience, it's about the unique capabilities that mobile devices offer. Say from biometric security to location-based services to real-time notifications even. And the data supports this trend. So because we are already at 72% mobile banking adoption in the US, for example, currently, and this number continues to climb. And regarding physical branches, I would like to emphasize something important, that while digital channels are growing, branches aren't disappearing. So, and as we said before, instead, they are evolving to focus on complex financial needs that require human expertise and advisory services. So we can think of wealth management, business lending, and or major life event planning. And these are areas where human interaction adds tremendous value. And branches are transforming from transaction centers into advisory hubs, and this hybrid model represents the sustainable future. And the third trend is what I call data-driven hyper-personalization. Because as the computing power increases and AI capabilities advance, banks will be able to leverage robust predictive analytics to offer truly personalized services, because we are moving beyond basic demographic segmentation to real-time behavior-based personalization. And for example, currently, predictive analytics already accounts for 73, almost 74% of variance in personalized banking experiences, demonstrating how critical this technology has become. And finally, the combination of automation and AI will transform both customer experience and security. And for example, automation will continue to simplify money management, from auto savings to automated bill pay to intelligent budget management, making safe financial wellness more accessible to everyone. And simultaneously, AI systems are becoming increasingly sophisticated at detecting and preventing cyber threats. And for example, research from the current year shows that AI adoption in banking could trim industry costs by up to 20%, while banks implementing advanced AI fraud detection, for example, achieve recall rates of 89, almost 90%, and can stop fraud attempts within just 5 milliseconds. And this dual role of AI, advancing both convenience and security, it is particularly crucial for the future of banking, because it really addresses the fundamental challenge of balancing innovation with the protection that I mentioned at the beginning of this lecture. And from my perspective, the banks that will thrive are those that master this balance, delivering exceptional customer expectations and experiences while simultaneously maintaining the highest standards of security and also trust. Okay, now let us summarize the key points we've covered about the evolution and future of digital banking. And these insights represent the most important trends and developments that will shape the industry moving forward. Looking back over the past 50 years, we have witnessed a remarkable technological evolution in banking. We moved from a purely branch-based service to an increasingly self-service oriented model, starting with that first ATM in London in 1967 and evolving through online banking platforms to today's sophisticated mobile banking applications. And what is striking about this journey is just how dramatically the pace of change has accelerated, especially the past decade. And fintech disruption continues to be a major force reshaping the industry, because traditional banks are facing unprecedented challenges from mobile-first competitors and neobanks that are reimagining banking from the ground up. And this isn't just creating competitive pressures, driving innovation across the entire banking ecosystem. And as we saw, for example, with companies like Chime or Revolut achieving massive valuations and user bases, I think that these new entrants are fundamentally changing customer expectations about what banking should be. And the power of data-driven personalization cannot be overstated as well, because we are seeing increased computing capabilities, enabling greater personalization, greater automation, and AI applications throughout banking services. For example, from my experience, this may represent a fundamental shift in how banks understand and serve their customers. For example, the ability to predict customers' needs, to automate routine tasks and deliver hyper-personalized experience, as to my opinion, is becoming the new competitive battleground. And also research shows that the predictive analytics now accounts for over 73% of variance in personalized banking experiences. And also security remains absolutely paramount in this digital transformation, because as digital banking capabilities advance, so do the threats we face from hacking, fraud, and cyber attacks as well, because this requires continuous investment in fraud prevention and cybersecurity technologies. For example, with $16 billion lost to bank fraud in 2020 alone, and biometric authentication now used by 70% of US financial institutions. I think we are seeing the industry take these challenges seriously. However, this isn't just about protecting assets, because I think this is about maintaining the trust that's fundamental to the banking relationship. And also looking forward, we can expect several key developments. Like, for example, mobile will definitely become the dominant banking channel, with adoption already reaching 72% in the United States. And physical branches won't disappear, but they will increasingly focus on complex advisory services where human expertise adds the most value. And hyper-personalization will become standard as predictive analytics improve, and automation will continue simplifying money management through tools like auto savings and intelligent bill pay. And perhaps most importantly, AI will play an increasingly crucial role in managing growing cyber threats while simultaneously enhancing customer experiences. And this transformation we're witnessing is profound, but I believe that we are still in the early stages of digital banking full potential, because the convergence of AI, of blockchain, cloud computing, emerging technologies like quantum computing, I think they are all promise to unlock capabilities we can barely imagine today. Because the banks that thrive these be those that successfully balance innovation with security and embrace new technologies while respecting customer trust and continuously adapt to changing customer expectations. Okay, and now we come up to the next quiz. So the question is, which technological capability is predicted to simplify money management and the most in future digital banking? Please choose one of the answers and type in your selection into the chat. So let's take, say, a couple of minutes for that. Okay, so the unique answer is third. So let's look at the right answer then. Yeah, thank you very much for your participation. Yes, you're quite right. The right answer is third. Process automation for transactions. And here you can find the explanation of this answer. And next, let us come up to the issues for discussion. So we have for about 10 minutes left. Please take your time and try to select one of the of these three issues, and please type in your answer or your thoughts on this issue, for example, your opinion, into the chat. And if we have time left, I'll try to give you my opinion on those issues. But if not, I will check and track your answers, and we may get back to it at the beginning of the next class. So please take 5 minutes to answer, to give your opinion on this one of these issues. Okay, let's get back. So I see your answers, your opinions. I will track them for sure later on. As for the following questions, maybe anyone wants to talk about it, so you are welcome. We have for about 4 minutes left, so you have a possibility to tell us about your okay. Let me tell you about my views on these questions. first, for about balancing innovation and security. So I think that as digital banking capabilities grow more advanced, and so do the risks from the hacking, fraud, and cyber attacks, as we said before during the lecture. So this requires actually continuous investment in security technologies, and as you can see, and also the rapid advancement of technology has really created opportunities for quick transactions and improved experience. But it's also opened the doors to complex banking crimes, including cyber attacks and data breaches and identity theft, for example. And here the question we need to ask ourselves is, what is the right framework for maintaining this balance? And so it's not enough to simply invest more in security, because it's obvious that we need to think about embedded security considerations into the design of new products and services from the very beginning. And for example, industry leaders are now adopting what is called a compliance by design approach, which is integrating compliance seamlessly across all business operations to reduce inefficiencies while fostering a proactive risk management culture. And the second question, the second issue is about challenge is about managing disruptive forces. So how should traditional banks evolve their business models to contend with mobile-first competitors like Chime and so on? Frankly speaking, from my perspective, banks need to make strategic choices because, for example, do they partner with these disruptors, or do they build their own competing platforms, or do they focus on areas where traditional banks still have advantages like trust, regulatory expertise, and deep customer relationships? And the answer likely involves all these three approaches, because but also the specific mix will depend on each institution's strengths and market. And the third challenge, the third issue, this is where I think the cloud technology may become essential, actually, because, for example, research shows that cloud migration could reduce bank costs by up to 30% through consolidated systems. But this transition requires careful planning, and banks must balance, for example, the imperative for modernization with the risks of disrupting critical operations. And what I've observed is that successful transformations require a phased approach. So also strong partnerships with the technology providers and unwavering commitment from senior leadership as well. And overall, I think that all these three challenges, like balancing innovation with security, managing disruption from new competitors, and transforming legacy infrastructure, so they are all, for sure, they are all interconnected to each other. And success in one area often depends on the progress in the others. And banks that develop integrated strategies addressing all three simultaneously will be the best position for the future of digital banking.